So I made mention about this in the loot room today. Our green and red dotted lines that you could see on this chart, VWAPs, the average price over the last hour that the longs we identified are long from, and the shorts we've identified are short from. Green for long, red for short. Now, transitional, when you get below those levels, generally they're great pivots, right? Bearish below, bullish above. We sink and go lower in this move right in here. If we take the slider here at the bottom, we run up to where? The red VWAP and come off. Just watch price move up to the red and come off. Once it gets through the red in here, green, and comes off. We fast forward it. We stay underneath the red. We come up to the red and come off. We now really get stepped on, come back to the red, come off sideways to the green. Now we use kind of the sandwich in between, marks the range and the consolidation. But either way uses the green up here as good resistance and rolls over. All the way down into here. We come back up to the PWAPs. And here, when we finally move through it, it starts to become transitional. What's often referred to as B to B, standing for bearish to bullish or bullish to bearish. A transition in the market so that sooner rather than later you could stop fighting it. But there's clues if you've got good support resistance. That's if you've got good support resistance lines. They're also helpful when they don't work, because they're not going to work as good resistance or good support forever. They're just not. No good line in the sand is. In fact, the more it works, the less likely it's going to continue to work. It's the metaphor running your shoulder into a locked door. You keep banging into it, the hinges get more and more loose, and at some point the door flies open. So you got to look at the market and price action the same way. A lot of people who are novice and newer to this business will think of support being support because it's already been support. They look at support after most of the rest of the world seen or saw that's already been support. For example, you see it go down, come up, go down, come up, and now everybody's like, look at the great support there and there. Yeah, well, no kidding. If a fifth grader could see it, it's safe to say that most of the rest of the world could see it, and most of the rest of the world is not going to make money. There's too many people on that side of the market. So chances of it going down a third time and rallying is just less probable. You can't have a lot of people on the right side of the market and have it make everybody money. It's the opposite. Too many longs, too many sellers, too many sellers. The price of anything goes down. So generally, and this is what I say, if little Johnny, a fifth grader, sixth grader, who trades during recess, says, hey, look at this great support, and he's looking to buy it down here a fourth time, and it does this and runs right through him because he's seen it work great these times, then the time he plays it, he's got to go crying to mommy. So the more support works, the less likely it's going to continue to work at that particular level. So there's transitional moments that you see, like in this area, when, hey, be careful playing it resistance because it's already worked really well. There's other clues in here that the upside might be the right side. Now, again, we already see it's rallied, but look at the objective clues when you get a pink triangle of an imbalance get taken out right away. When the laser goes green to red and green to red and gray to white, which shows more shorts than longs and more aggressive buyers than aggressive sellers in this area right here. And so transitional moments, or B to B, bearish to bullish in this example, create the anticipation that the upside might be the right side, and it comes back and it leans on this now as new support. So your predictions don't feel like guesses. You got to get on the right side and then look at picking better locations with better timing. It's just not good enough to say you're bullish and right most of the time. You got to qualify or disqualify the idea, or you're going to be picking bad locations and get mad that you're right on direction, but don't have anything to show for it. You miss potential winners and you catch all the losers within your directional call because you're picking bad spots, or you don't have the tools to qualify better spots. And that's not always snap of your fingers and you're going to be able to address that right away because most people don't even think of breaking down their strategy, ready, aim, fire. Even though everybody's strategy has a step by step approach, whether they know it or not. Just because you might have a bad step by step approach doesn't mean you don't have a step by step approach. For example, there are some people that just take shots and they're bullish because their last 3 trades were shorts and they lost money. That's why they're bullish. That's a step one. It's not a very good step one, but it's a step one nonetheless. And then their trigger to get them in is because they were pissed off. They just missed a long prior, and so the next time down, they just took a shot. Again, that's a step. That's a fire and ready aim fire. So it's not a very good one. So everybody has a strategy that has a progression, a step-by-step approach. Oftentimes, they can't identify it, or it's not very good steps, and there's no probability stack behind it, or any kind of understanding that you could do with them. So therefore, there's a lower level of consistency, and you end up just trading randomness. And then you have a run where you make decent money that particular day, whether it's real or sim, and you're like, all right, but if that felt like it was a good guess or you got lucky, there's going to be no consistency that follows it. There has to be a sense of, hey, I think it's going to rain this afternoon, and here's why. And meteorologists could cite that. And as a trader, they're wrong a lot. We're wrong a lot. But it's, can you disqualify your opinions when you're going to be wrong, therefore taking less losers? Can you have better qualifiers so that you're picking better locations so you miss less winners? A lot of people miss winners. They talk themselves out of it. They cut it too short, whatever. And when you miss a winner, it doesn't go on your Excel spreadsheet. It doesn't come out in your statement. And oftentimes people don't review what they don't trade because they didn't trade it. But yet missing trades, especially when most of them are winners, is very impactful into what you're going to do next or what you're not going to do next. Some of your worst decisions are going to be after you missed and talked yourself out of what would have been a winning trade. And oftentimes, if you don't take, let's say you talked yourself out of taking a long down here, which would have been a nice effortless winner and market rallied, everything else. So then the next time it comes down, you take it and it runs right through you. But if you would have taken the one you missed, you wouldn't have taken the one subsequent to that. Do you see how that goes? So not only do you not have the winner, but you have a loser that you wouldn't have. So you got one less winner and one more loser because the confidence isn't there and the ready, aim, fire approach isn't there and there's no objectivity. So now it's all subjectivity. Now it's all emotion. And you're making more decisions based on being pissed of what you did or didn't do prior. A lot of people also have good step ones, but they don't realize that. And so when they're inconsistent, they're starting to work on a part of their strategy that they should leave alone. They start tweaking a part of their strategy that actually is their strength. But because most people don't break down what it is and how they approach the market, they start tweaking something that's their strength. They're unsure or unaware of what their weakness is, so they have no chance at addressing that. And so I always try to work backwards with people and say, generally everybody's weakness and what you always have to work on is your step 3, your fire in this ready, aim, fire progression. Your ability to pick better locations to get long or short, which all is about timing. My definition of a good location is having the trade go your way ASAP. The faster it starts going your way, not straight to your target, but starts going your way, the better the timing was. And it doesn't always have to do with a lower price if you're trying to get long. Conventional wisdom and little Johnny would say, I'd rather buy 21s than 28s. Well, yeah, if you're just looking at what's a lower price, everybody wants to buy it lower. But what if at 21, after you bought it, the market did this for a while before it finally did that? Whereas if you bought it at 28, it went like that. Now the timing and now the idea of higher is better makes sense. And I'm just using these numbers, obviously, for example's sake, but sometimes not 7 points difference, but you get the point. Timing and going your way right away is always going to be the definition of a good location, not always the exact the price or the area you bought. But what happened? How long do you got to screw around before it starts going your way? Because the longer it hangs around your entry, the more self-doubt's going to creep in. And then, should I adjust my stop? I'm risking 6. Should I risk 4? If I risk 8, this one would have been a winner. And you start to just kind of knock over a bunch of Lego pieces, and you've got a floor full of Lego pieces that aren't organized. And now you're supposed to get better. And a lot of people go down rabbit holes with all the great information, but all the bad information that's available on this thing called the internet. So ready, aim, fire, understanding every strategy should be broken up, just like any approach to learning anything should be broken up, and then understand the pieces and put them together. It's the way the website's broken up for a reason, and it's the way your playbook could kind of be broken up. Talk to yourself. Why are you bullish? Why do you sit up in your chair getting ready to aim? And then why did you pull the trigger and get long, which is fire? And then there is a step 4, getting out. And getting out's important. Knowing where you're going to get out before you get in is important. But everybody wants to rush to risk management when they're struggling about this business, and they think that's the fix. And it's like bullshit. Your risk will be managed better if you're picking better locations. You got to figure out and understand what you're doing first. Then the psychological books might help. Then understanding the marriage between the mind and the markets and all the emotions that go into making any decisions, let alone trading decisions. But a lot of people put the cart before the horse, and they think that their inconsistency is due to some psychological problems that they're having. And so they buy books and they go to webinars to oh, this makes sense. No surgeon in the world is going to do, you hope, yoga or Zen-like breathing exercises if you're flatlining on the operating table. You just hope they know what they're doing and they default to their training. And so all the psychological help is not going to make the difference between being successful and not being successful. You got to know what you're doing first. Then it could help. Don't get me wrong. Then it could help immensely. But a lot of people think that's what they're missing. But what they truly were missing is knowing what the F they're doing in the first place.